Welcome to another edition of Strategic Financial Management. In today's class, we shall continue with our lecture on adjusted present value. And in our previous lecture, we were able to calculate, we were able to stop at the base case NPV of this question. We did not complete it because of our time. And I said that we should complete this question, get the NPV, so that today we can be able to move on. So please confirm. I just need figure. Don't forget that adjusted present value have two items. What are the two items? The base case NPV and the PV of financing effect. The base case NPV, you use the ungeared cost of equity to discount the project. You use what? Ungeared cost of equity to discount what? The project, right? Which will include the business risk, right? While the PV of financing effects, you use the commercial rate to discount the project, the higher rates. We have the subsidized rate as well as what? The commercial rate. So you use that to what? To discount the what? To discount the project. Now, another thing is the base case NPV is based on your normal capital budget, right? Which considers all relevant cash inflow as well as what cash outflow. So we're able to, where we stop is we're able to stop at this part in our previous lecture. Please, what I need now is just figure. Please confirm if this DCF is correct. Is this DCF, is it correct? Please give me figure.
114.6.
Where?
Yeah, one.
Is it the figure? Is the DCF like this? Is it correct? Using 12%.
Yeah,
Is
but
it
the
correct?
third one is 0.73.
Okay. Third one, this.
1.12 raised to power minus 3. 0.71. Yeah, this one is correct. It's correct.
What of this?
Yeah, that one is correct as well.
Okay. So give me the final figure, please. Multiply. Just give me final figure.
114.6.
Okay. Coming. Okay. Give me figure.
114.6.
114.6.
186.9.
186 point what?
0.9.
Point 9. Please confirm this figure. What do you have here?
412.3.
412.3. What do you have here?
330.1.
330.1. Right?
Others can confirm, yeah.
Okay, that's fine. So this is the PV. So what is the MPV now? Please, others should confirm this figure. This figure, disclaimer. Who gave me this figure? Exclusive.
NPV is 335.
Okay, that's fine.
335 positive. Please let another person confirm, please.
Okay, that's fine. So MPV
335
finance. Okay, I'm coming. 335.
positive.
Okay, in million, right?
Yeah.
In million, right? So this is positive MPV under the base case MPV. Under the what? Under the base case MPV. We are done with this. The next thing is what? The PV of financing effects. The
Hello.
next is what?
335 how? The MPV is 184, 184, 883, 600. The summation of all these things is the summation of all these things now is
minus the first year. This is how. Please now, you guys should calculate this thing and give me a figure so that we'll not waste much of our time here, please. Someone should confirm this so that we can move ahead,
the
please.
summation
Any
of all
figure
this
you give me.
positive MPV is 1,043. Then you less the year zero, which is 859. You have 184.
Okay, please, others should confirm that. Please, others should confirm.
Hello, sir. I,
Yeah.
I, some of the figures are not correct. I
So,
don't know. Maybe others should confirm.
where is it? Where is it? Let's quickly correct it. From this plot, is it this one?
Yes,
The DCF?
PV.
Okay, the PV. Okay, which one of them, please?
Yeah, two is 185. Unless
Yeah,
that DCF is not correct. But I'm using the DCF to multiply. It is 185.3.
you have 185.6. So when you approximate it, it's still,
85.3.
yeah. We use two decimal places, right?
Okay.
We use two decimal places. Okay. This is 114. Okay. Okay. Please confirm this last one. What do you have here? Is this correct? Okay. So since we use two decimal places, oh yeah, now add minus. What do you have? We should not have this huge amount. Something is wrong. Okay, add the positive minus the this thing. What do you have? What do you have quickly? What do you have? Oh,
4.41.
one what?
84.41.
184.41.
184,400.
Now, let me quickly make something clear here. Let me make it clear here, right? When you want to do your DCF, right? Please pay attention to this. When you want to do your DCF, always make it three decimal place. Let it to be three decimal. Three decimal 0.89 something, 0.79 something, 0.71 something. So this one we add. If you want to make this three decimal, what will you add to this? Always make it what? Three decimal place, right? So let's add this. Olanike.
Thank you, sir. I've done this before. So I use three decimal places, and that's why I've been looking at what could have caused the difference of my MPV was 172.46, and now we have
Yeah.
4.41.
Okay, that's fine. That is why I said, let me quickly make it clear. When you want to determine your DCF, please always make it to be three decimal place. Let's set that standard from now. In anywhere you want to do your DCF, just make it three. Let it be three decimal. Please let it be what? Three decimal. Please give me figure of this. This is 0 point what? Let me quickly correct this. 0.8389 what?
893.
Okay. Then this is what?
797.
Okay. This is what?
412.
712.
This is what?
636.
Okay. So that's fine. So please multiply this so that we can get
The first one is
this thing.
114.95.
I'm coming. 114.95. Next.
That one is correct. 186.90. And the next is
Okay.
402.09. 402.09.
Okay.
328.01. 328.01.
Okay. Okay. So what is now the MPV? It's better we calculate it here. We discuss
17.46.
17.
0.46.
Okay. 172.46
46.
million. So this is the base case. Please always make your DCF to be three decimal. Let's be using three decimal places, please. So just make it three. So, class, we all agree with this. Now, our next, after the base case, we'll determine the base case MPV. The next thing is to do the PV. of financing. Okay, before we talk about the PV of financing effect, we need to bring the sources of finance. We bring it out. Sources of finance. Sources of finance. How the project will be financed. We need to know that. We need to go back to the question and check how the question will be what? Will be financed. Right? Sources of finance. Right. So sources of finance. So now let's quickly go back to the question and check what is the sources of finance. We'll just read the part of the financing effects. Now this is the highlighted in yellow is the part of financing effects, right? Then we also have one here, which is the normal borrowing of 150 basis what? 150 basis what? 150 basis points, right? 150 basis points. Now, it is anticipated that the project will be financed entirely by debt. I've mentioned this. I've said it that if you said this project will be financed by debt, it means that entirely, including the working capital, is by debt. Including the what? They say is entirely by debt, which means that the working capital you also use is also is also what? On debt. Right? So addition of your investment plus the what? The working capital will give you the total finance, the cost. And they said 60% of which will be obtained from a subsidized loan. Subsidized loan scheme run by the government. So now let's pick it from there. Subsidized loan, sources of finance. Oh, we have to be scrolling down. Oh, okay. Let me do something so that we'll not be going fonts. I'll just copy this part. I need to copy this. I'll just copy this. Then I'll delete it later. So please pay attention to this part of financing effect, right? Now, so we'll be looking at it. Now, everything will be financed entirely by debt. Please confirm if you can see my screen. Can you see it? Confirm if you can. Okay, that's fine. Now, everything will be financed by debt, which is inclusive of your working capital, right? Now, total investment cost is equals to the investment plus the working capital. So what is this? The investment is what? From the question, the investment. Let's quickly go back. Let's check. What is the investment from our PV? What is the investment class? The investment is 760. Is that not so? What is the working capital? The working capital is 99.49. Is that not so, class? Hello? Please, let's answer now so that I will know that you are following.
Yes,
Please.
sir.
Okay. So 760. Because it will be financed entirely. You finance the project entirely by debt. Right? By what? By debt. Plus 99 point what? Point what? 0.49, right? So what do we have? What do we have here? When you add it, what do you have?
859.49.
859.49 million. Right? Because we're told that everything will be financed by what? By debt, including, because if they say the project will be financed, but it is inclusive of the working capital. So therefore, and we're told that of which 60% will be obtained from subsidized loan. Class, 50% will be obtained from where? Subsidized what? Subsidized loan. So we can come here and say subsidized subsidized loan, right? Subsidized loan equals to the 60% of this will be from the subsidized loan, right? Will be from where? Subsidized loan. So what is the 60% times this? What is the 60% of 8,859.49 million?
Five
What is this?
515.69.
515.69 million.
Yes.
Okay. Now, what will now happen to the balance of figure cross, right? What will happen to the balance if this is for subsidized loan? Now, the question now is, what will now be the rates? Just like the way we are doing it. Please don't forget. Just like the way we are doing it, isn't that so? Now, if 60% will be financed by subsidized loan, what is the rate? What is the rate for this subsidized loan? Now, look up. The rate is now that 60% of which will be obtained from the subsidized loan scheme run by the government, which lend money at a basis point. Or should I remove this yellow? Let me remove it. So, in case you are not seeing it well, right? Now, which lend at a rate of basis points, 100 basis points below the 10-year government debt yield rate of 2.5%. So it will be 100%, 100% basis point below the what? 2.5. Class, what it means is that the rate will be 100%, which is 1%. It will be 1%. 100 basis points. It means 1%. 20 basis points. 20 basis points means 20%. 5 basis points means 5%. 10 basis points means 10%. Now, it will now be below 2.5. Class. So, therefore, the rate, right, below it, below 2.4. Therefore, we have the interest rates will be equals to below the so you have 2.5% minus 1% because it is 100%, 100 basis points below. So what do you have? This is 1.5%. So the subsidized rate, you can see, I told you, at the beginning of this class, I bring so many case scenario that this case scenario could be, in another case scenario, it could be that the commercial rate is 100% basis point above the subsidized rate. Above, you are adding it. Below, you subtract it from what you are given. Right? Below 2.5, which means that they will give you a rate below 2.5. Below 2.5 is 1.5. And don't forget, you still have 2.5% here, right? You still have what? 2.5%. So that is the rate, right? That is the rate. Permissive.
I don't still get this analysis of 2.5 minus 1%.
Okay. Okay. You've been in our class for
Mm.
adjusted present value from the beginning, from when we start till date.
Yes.
And you always know that subsidized loan will be lower than commercial rates.
Yes.
And they are telling you that the subsidized rate ideally supposed to be given to you, but they are not giving you. They are telling you that it is 100%, 100 basis points below the government yield given to you, which means that the basis points, the rate will be 100% below the government yield rate of 2.5%. Now the question now is, here is the commercial rate. They don't want to do it based on, they are giving you subsidized rates that will be below the commercial rate, right? They say 100% below it. What is the 100%? 100%, 100 basis points means 1%. It is 1%, right? It is 1%. 20 basis points, 20%. Is that not so? So now, if 100 basis points, 100, that is 1%. 100% divided by 100%. You have what? You have what? 100 divided by 100, you have 1. Now, it's below it, which means that if they want to give you the loan, they will not give you at 2.5. It will be below the 2.5, 100% basis point below it. Below it means that you have to remove that 1% from 2.5% so that you get the rate of the subsidized rate. That is what it means. Do you get that? So, if this is established, oh, right? Oh, sorry. Now, if this is established, this is the rate for the subsidized what? For the subsidized rate is this. Now, what of the commercial rates is another problem. Now, let's finish the question. Now, and we're told that the issue cost relating to the raising the finance are 2% of the gross finance required. Class, what is the finance required? The finance required is that this project will be financed entirely by debt. So definitely, both your subsidized loan and commercial loan will be on issue cost because the project will be financed by what? By equity, by debt. Class, let me take that again. Let me take that again. The issue cost related to rising the finance are 2% of the gross finance required. Usually they will tell you that 2% is for equity, 2%, 1% is for debt. But this now, because the project will be financed entirely by debt. So your issue cost will be the entire debt. Then what is the entire debt? Your subsidized loan and your what? And your commercial loan. So you charge issue cost on the finance required, which is what? Finance debt. The subsidized loan as well as the commercial what? Loan. We will get there. Right? I just needed to explain that part. Now, the remaining 40% will be funded from FPLC normal borrowing sources. Let me quickly copy that normal borrowing sources that was mentioned in one of the that was mentioned. Okay, this is this. Let me copy it so that you'll be seeing the two. Oh, okay, interesting. This question, the financing part is the interesting part, right? It's interesting. Just pay attention. You get it. Get it. Okay. Now, and we're told that, this will come before this, okay? Now, and we're told that the remaining 40% will be funded from FPLC normal borrowing sources. What is the normal borrowing sources? Your normal borrowing sources is commercial debt. Don't forget, 60% will be financed by subsidized loan. The remaining 40%, normal borrowing is through commercial. Normal borrowing. Automatically, normal borrowing will be through your normal commercial bank. Right? Apart from if you don't want to go by government, it's bank. So 40% will be financed through the what? Normal borrowing sources. So therefore, we can have the commercial loan, commercial debt, should be debt, 40% of the balance times 40% of 859.49 million. What do you have here? What do you have? Figure. What do you have? Figure.
343.80.
343.80. Good. Now, the question now is, don't forget, commercial rates will always be higher than the subsidized rates. So this question is an interesting question, right? So let me show you how I convert this 1%, this 100% basis points. Let me just show it somewhere so that tomorrow someone will not ask that. IB, how did you get 1%? 100 basis points is equals to 100 divided by 100 equals to 1%. Right? So if you are given 20 basis points, 20 basis points, 20 divided by 100 will give you the basis point percentage. And that is how it works. That is 20%. Right? This is what 100 what? Basis points percentage. Now, this is the rate. Now, the question now is, which rate are we going to use? Because any rate we are using should be higher than, should be more than the subsidized rate of 1.5 million, of 1.5% class. Now, before now, we were given that there is interest is based on FPL's normal borrowing rates of 150 basis points over the 10-year government yield. Now, the normal borrowing rates at which FPPLC usually is 150 basis points. Now, we need to convert this 150 basis points. Now, let's convert the 150 basis points. Right? 150 basis points is equals to 150 divided by 100. What do you have? You have 1.5. 1.5. 1.5%. 1.5%. Now, class, this question is an interesting question. I want you to pay attention to this part. Now, the normal borrowing is 1.5%. And this 1.5% is equals to the subsidized loan, which means that it is even lower. They are both the subsidized and this thing are equal. Now, so therefore, don't forget, let me now take you back. Let me take you back to the Nigeria economy. Now, currently, MPR is about 27.7% or 27.4% after the rebase of what is it called of inflation rate. You have about 27 point something percent. That is the interest rate from the central bank, MPR. Now, when you go to the bank, bank will lend you at what? At 30%. See, I want everybody in this class, right? We are both professional colleagues. Do you know why we are different from others? Why next gen professional is different from others? It is because we incorporate what is applicable in practice to to theory, so that students will be able to understand the concept, the whole concept of all this calculation. That is 90% of what we are doing in class. It is still applicable in practice. I may not be there. I may not be working as investment analyst or senior financial analyst or anything. It doesn't matter. It is research work. We've done so many things, right? Now, the NPR is 27. Please confirm. Are we good to go? Are we good to go? So we have established that the subsidized loan is 1.5. The commercial rate is 4%, right? Is what? Is 4%. Class. Okay. Our first step is issue cost. Issue cost. We're told that the issue cost will be on the finance. So we need to go back and check. We need to go back and check for the issue cost. Now let's quickly go back and check what. Oh, I have it here already. Sorry. Okay. Okay. Now can you see it? The issue cost relating to raising the finance are 2% of the gross finance. Class, of the what? Of the gross finance. What is the gross finance? Is that the business will be financed entirely by debt. The gross finance is the business will be financed entirely by debt, right? Is that not so? So in this case now, the issue cost we apply on the sources of finance, which is either we start with cheap loan or the subsidized loan. Subsidized loan, right? So what is the subsidized loan? The cost, the way we normally do it. What is the cost of the subsidized loan? That is 515.69 million. Oh, I'm supposed to bring this one down. Okay. Then the issue cost. Don't forget, this subsidized loan is assumed to be on the net amount, right? So we need to gross it up, right? We need to do what? We need to gross it up. Class, we need to do what? We need to gross it up. So the issue cost is 2%. So you say 100, 2 minus 100, if you minus 2 from 100, you have 98 times 515.69. So what do you have? Class. Figure. Figure.
10.5.
Where is Olanike?
10.5 million.
Okay, I'm coming. Okay.
Yes, sir.
Okay, that's fine. 10 point what?
5 million.
10.52. Is it 2 there or 10 points? There should be points now since we have
10.52.
Thank you. So what is the gross amount? What is the gross amount?
526.
Okay, I'm coming. 526.
0.21.
Okay, that's fine. This is the gross amount. That you don't forget let me bring our format of financing effects so that will be where is it? Where is it? I'll just copy it. Where is it? I think just copy the old format so that you will see what we need to do, what we need to do. Sorry. Okay, this is okay. Don't forget you use commercial rates to discount. You use commercial rates to discount. Okay, let me put this here. So this is the step. Don't forget there is no equity. We only have debt, right? Commercial rates. Rates. Okay. Okay. So if this is the gross amount for the subsidized loan, don't forget they say the 2% will be applicable to look at it to class. The issue cost related to raising the finance are to raising the what? Rising when you are raising the finance are 2% of the gross finance. 2% of the gross. So which and we're told that the project will be financed by what? By debt, right? And entirely by debt. Entirely by debt. So which means that if it is entirely by debt, so definitely both your subsidized loan, it will be financed, and as well as what? The commercial loan. And how did you want to get this finance? The issue cost will be the total entire debt. Total what? Entire what? Debt. Right? So this will be at year what? Year 0, as usual. So the next one is commercial loan. Oh, we don't have enough space. Okay. Commercial loan. I just want to use this part. Okay. Commercial loan. What is the commercial loan? The amount. The original amount of commercial loan. Where is it? Let me use commercial loan. Commercial loan. This is it, right? This is the amount. So the issue cost is 2%, 98 times 343.80. So what do you have here? What do you have here?
7.
Olanike?
7.02.
Okay.
02.
Pemisire, are you still in this class?
Yes, I am.
Okay. Hope all is well. Ask question now.
It's okay.
So why is the addition? What do you have?
350.82.
350.82. So this also will be at year 0. Please don't forget this test. Always understand that PV of finance. See, always analyze this PV like this class. Always analyze it. See, these are the sources of finance. Always analyze it. Analyze it. Okay, is it financed by equity or only by debt? Now, the question says that it will be financed entirely by debt. And that is why we added working capital to it because it is assumed that the project, everything will be financed by what? By debt. And they now say, oh, 60% will be for subsidized loan. Excuse me. And the remaining balance, which is 40%, will be for commercial, which is the normal borrowing. Right? Which is the normal borrowing. Now, if you add these two together and these together, you have 859.49 million. Right. What is the commercial rate? Is 1.5. The subsidized rate is 1.5. The commercial rate is what? Is 4%. Then we now come back to issue cost. Why do we have to use issue cost on these two? It is because it is based on the finance amount. We were told here that the issue cost related to the rising the finance and the project will be financed entirely by debt for the subsidized as well as the what? The commercial. And that is why we were able to do it this way. Okay? Exclusive.
Okay, thank you, sir. Sir, please, assuming for this particular question, assuming this, we have also equity as a source of finance, and we also have this working capital. So how do we treat it? Because, yes, can you hear me?
If you have that, the question will tell you that this also percentage is for equity.
Okay.
And
That's the percentage of the working capital.
No, not percentage of the working capital. The percentage given to you, you charge it on it depends on how the question says that entire by debt. In that, the question will not tell you that it is entire by debt. They will now break it for you that it is equity. So if it is equity, it is not, you don't need to add the working capital to it because
Okay, thank
you
you.
don't need to add. If you see equity, it is not, so definitely they raise. If you see equity, it means that they raise fund through equity. So the working capital will not be assumed to be
Debt.
added to it,
Okay,
right? It
okay,
shouldn't be.
okay.
Do you understand?
If the
I can
source of
hear you.
finance, we have equity and debt, so we'll just ignore the. I mean, so if we have the equity and debt as sources of finance, we'll just ignore the working capital,
Of
unless.
course, see, exclusive. You ignore it. Do you know why? Okay, I'll give you practical reason. You want to embark on a project. Your company is a limited liability company. Don't forget, FPLC is a limited liability company. And they want to embark on a project. Don't forget, this company can raise funds through what? Right issue. So you will not assume that working capital will be added when the question says is by equity and debt. You should know, automatically you should know that, oh, the working capital, they might have raised this working capital through right issue. So you don't need to add it. Part of the cost of it. Part of the cost. You don't need it. So it is only when it is being financed entirely by what? By debt. Before you can say entirely by debt. So it means that including with the working capital, it was financed by debt. Of which, at the end of this class, I think they actually state that we should state assumption, right? Of which, at the end of this class, we'll look at the assumption. Class, are we still together?
Please, I don't get that explanation. Sorry. Moses talking. Sorry.
You get it later.
Okay, thank you.
Yeah, thank you. So now, if this is established, we need to move ahead to number 2. Based on this, number 2 is tax savings on issue cost. Now, in this question, don't forget, I've mentioned it several times. When the question is silent, you only do it on the debt. On the debt only. Don't forget, I've mentioned it several times. It is assumed to be on what? On debt. Right? It is assumed to be what? On debt. Now, look at this question now. The tax savings on issue cost was not actually mentioned. But guess what? Since it is only financed by debt, the tax savings will be on the debt. Class, in this question, it wasn't mentioned that there will be tax savings on this because there's no equity in them those now. So the tax savings will be on what? On debt. But the subsidy, because the entire project will be financed by debt. So it is silent. So you do it both on the two what? On the two debts, which is what? The subsidized loan and as well as what? The commercial loan. Because the question is actually silent about it and the finance. And it will be entirely financed by what? By debt. So therefore, it is assumed that the tax savings will be on the two debts because it is debt. Is that also? There is no what? Equity. Now, in this case, we can have Roman figure 2. Number 2. Right? So tax savings on issue cost. Tax savings on issue cost. Entire use the debts. So, what is the issue cost of the first one? The first one is for the subsidized 10.52. 10.52 plus the next issue cost 7.02 times tax savings. How many percent is the tax given to us in this question? How many percent is the tax given to us in this question? How many percent, class? 20%. Okay. 20 what? 20%. Okay. 20%. So what is the tax savings? What is the tax savings on issue cost? Don't forget that tax savings on issue cost is assumed to be year what? Year 1. So what is the tax savings? Quickly.
3.51.
What do you have?
3.51.
3.51. So class, what is the next step? After tax savings, so this will be assumed to be year what? Year 1. What is the next step? What is the next step?
To
What is the
calculate
next step?
tax savings on interest costs.
Okay, interest cost. Okay, that's fine. That's a very good one. Tax savings on tax savings on interest costs. Tax savings on interest costs. So, tax savings on interest costs. So how do we go about that? Where is it? Tax savings on interest costs. So, there is interest for both commercial and subsidized, right? So, subsidized. So what is the interest rate? Is 1.5% times. So how much are we borrowing in total? How much are we borrowing in total? Hello.
859.49.
You say?
859.49.
Who is that? Who gave me that figure? 85 what? Who gave me the figure as 859? Rachel, are you the one? Rachel,
Yes, sir.
Are you the one that gave me that figure?
Yes, sir.
Okay. Now, tax savings on interest cost, right? Class, what is the total cost of borrowing on interest cost? What is the total cost of borrowing? Is what? 526.221. Class, it seems that most of you did not go back to the previous lecture. I don't think you go back to the previous lecture. If you actually check the previous class, what we did, excuse me, the subsidized loan. Now, the subsidized loan, there is no issue cost on the subsidized loan. I get what Rachel is trying to explain, based on that figure. In our previous lecture, there is no issue cost on subsidized loan. We use the figure entirely, but in this question, we were told that it is financed entirely by what? By debt. So therefore, the issue cost given to us, it was even stated on the gross amount of finance raised, and the finance raised, excuse me, is both what? Subsidized as well as what? As well as the commercial. Rachel, do you get that now?
Yes, sir. I've gotten that, sir.
Okay, so it should be
Thank you, sir.
526.21 times the tax savings, which is 20%. What do we have? So the commercial loan, is 4% times what is the gross amount, because this one has issue cost, 350.82. Please, 350.82. Don't forget, in our previous lecture, the subsidized loan we did not use the gross amount because it does not have issue cost. We use the original amount. But this, because the question says it is financed entirely by debt, we have issue cost, so we need the gross amount. So this commercial, we have the issue cost, the gross amount, times the 20%. Class, what do you have? What do you have quickly?
157.86.
The first one, right?
Yes, sir.
Okay. One what?
157.86.
1.57.
No, 157.862.
1.58.
Okay, next. Next, what do you have?
2.8064.
8064. Right? So what is the addition? If you like, you can use the full amount. Fine. So what is the tax savings? The total?
4.39.
4.39. Don't forget that at the beginning, it is assumed to have issue cost at year 0, as usual. The tax savings will be year 1. Then this now, since we were told that tax is being paid in the year at which the profit is being made, taxes is not based on arrears, right? And the numbers of years is year 1 to year 4. So therefore, you can say year 1 to year 4. Hadn't been, excuse me, hadn't been it is in arrears, we would have 2 to 5 years if it is in arrears. But because it is not in arrears, the tax is being paid in to which the profit is what realized. So you have year 1 to what? 4. Class, what is the next step? What is the next step?
The next step is interest saved.
Interest saved. So you still dey check your notes. Interest saved. So how much interest did you save? The difference between the commercial rate, then how much did you save? The commercial rate is still 4% minus the 1.5%. So where did you save it? Times, you save it on what? On what? On where did you save it? On the subsidized loan. Is that not so? Class,
Yes.
hello? Right? Now, you
Yes.
can see in our previous lecture, you save it on the subsidized because that is where you save it because you decide to go, you have a subsidized what? Loan. Now, in our previous lecture, the one we solved, the subsidized, there is no issue cost on the subsidized. We pick the original amount, the original amount given to us, right? But now, since we have the gross amount, so we are picking the gross amount as well, right? Because of the issue cost. I think there is no issue cost on subsidized, we would have just picked the original amount of that figure, and we what? And we move on. Okay. So we have subsidized is 526.21. Right? So what is the interest rate on this? What is the interest rate? What is the gross interest rate? Quickly.
$13.16.
13.16. Please confirm. So interest save, you can see this interest save will be from year 1. There is no tax here, from year 1 to year 4. The usual. Year 1 to what? Year 4. Now, I didn't mean there is no tax here. It's still your normal year 1 to year 4. You save interest from year 1 to year 4. Right. So what is the next step? Tax paid, right? On interest saved. Of course, you pay tax on the amount of interest. So you save, this is what you save, right? Times 20%. So what do you have?
2.63.
Thank you, sir. 2.63. Thank you so much. Right? Tax paid. You pay tax. I didn't mean the tax is being paid in area. It could have been from 2 to 5. But the tax is not paid in area. So we can have year 1 to year 4. So is that all? That's all, right? Use, let me say 6. Use commercial rate of 4% to discount. So we are done with the steps, right? Are we good? Class, are we good? Hello?
Yes, sir.
Yes, we
Okay.
are good.
Okay, that's fine. Please, okay. I needed to confirm that. Please, if you need more explanation, let me know quickly. If you need more explanation, let me know. I'm still coming back to Mr. Moses, that your question, but let me finish this first. Mr. Moses, I did not forget to still remember. Mr. Moses, are you still with us or you are against us? I need to confirm that.
I'm with you, sir. I can't be against you, sir.
So, the commercial, thank you, sir. So the commercial rates, 4%, 4%. So there is no issue costs. There is no issue cost on debt. This will be year zero. What is this? No year zero, right? No year zero. So issue cost, this, sorry, no equity. So bring in debts. Okay. So you just give me figure, I'll scroll up, you can screenshot. Why this thing is not? Okay. So 4%. Oh, this will be a million. This will also be a million. Please always remember to put this to add all these things, right? So they are very important. Okay. So issue costs, let me scroll up so that you pick it. Can you see the issue cost? The issue cost here zero. Can you see it? So please you give me the figure. Ooh. Issue cost. Okay, let's just add the two together. Okay, what is the first figure? 10 point what? 10 point what?
10.52.
10.52. Thank you. Plus, what is the next one?
7.02.
7.002. Is it 02? Okay, let's check. Okay. 7.02. Okay. Then, what is the addition of this? Figure, please.
17.54.
24.
Okay, 17.54. That's a zero. This should be 1. Okay. Isaiah, are you still with us? I'm not sure. Okay. The next one is tax savings on issue cost. All right. Tax savings on what? On issue cost. Don't forget. I've mentioned it several times. If the question is actually silent about the tax savings on what? The tax savings on issue cost, right? And I said if it is silent about that, you use the commercial debt. But in this question, we're told that it is entirely by debt. The project is entirely by debt. So everything, we used to use commercial debt because we have the equity issue cost, we have the commercial issue cost. Is that not true? Is that not so? So since we have the issue cost on both subsidized as well as the commercial, right? So the issue cost will be on the two debts, entirely by debt, right? on the two debts. Now, so the issue cost, what is the issue cost figure? Issue cost, quickly, class. Okay. Oh. Please, screenshot.
Issue cost is 350.82.
350.82. So, year one, what is the DCF? Using 4%, what is the DCF? What is the DCF? Exclusive.
Tax savings on issue costs is, I don't think it's 350, 812, 82.
This is it now. Where is it? This is it. This is the tax savings now.
It's
Who gave me that
3.5.
figure?
1.
Felicity. 3 point what? 3 point what? 5.1, right? Please now, give me figure. Okay. 3.51. Let me do it by myself, so in case you don't want to give me figure. So you do the DCF by yourself. You will get the answer, please. I've been saying it. Give me figure, give me figure, give me figure. What is the DCF?
0.962.
0.962. Okay. What is the PV?
3.38.
You say
38.
3.38. That is what it give you, right? 3.38 when you multiply. Is
Yes,
that
we
what
have
you have?
662.
3.37662.
So the two decimal places, 3.38.
Okay. What next again? Tax savings on interest cost. What is the tax savings? That is 4.39. Okay. 4.39. So, and it is from year, let me check. From year 1 to 4. Year 1 to 4. So, what is the annuity? Annuity from year 1 to 4.
3.630.
Excuse me. 3.
630.
Excuse me. So what do you have when you multiply?
15 point. Let me 16.
15.
It's just 16. 15.9.
16 points.
15.
15.9.
Okay. Next is savings on interest. Interest saved.
0.16.
1 3. Interest saved. Interest saved. Interest saved. Interest saved. So interest saved is what? 1 what?
13.16.
13 point what?
16.
So what is the DCF?
16.
The DCF is still 3 point, yes. Let me say, can you see the difference now? That you are not doing from 2 to 5 because the tax is not being paid, it's not in arrears. So this is just straightforward.
All right, yes.
What do you have here?
47.77. 47.
Okay, 47.
0.77.
47, okay. Are you sure?
Yeah, she's correct.
Okay, that's fine. 47,
Point
that's like
point
0.77.
0.77. Let's check again. It's 13.1716. Okay, 47.77. Let me check my calculator. That's
correct.
Okay. Disclaimer. This figure is calculated by the...
It's correct.
Okay. So, tax page, year 1 to 4.
2.63.
Okay. Okay, 2.63, that's fine. 2.63. Uh, 2.63. So the DCF is still the same thing. Oh, so when you multiply, what do you have?
9.55. Bracket 9.5.
Okay. 9.9,
55.
like this. 9.55 like this.
Yes, sir.
Okay. So what is the PV of financing effects?
39.96.
39. Positive.
0.96.
Positive.
Yeah, positive.
0.96. Is that correct? Class, confirm that.
Yes, let somebody confirm, please.
Correct. She's
Okay.
correct, sir.
Okay. Okay. Adjusted present value. Me say I don't tire. Summary. Base case MPV. Base case MPV. MPV. So what is the base case MPV? Who have the base case MPV figure? Excuse me. What is the base case MPV? Let's quickly go back.
172.46.
Oh, good. Thank you. 172.46. So what is the PV of financing? PV of financing effects is 39.96. Oh, this is positive APV.
212.42.
Okay.
Total.
Okay, thank you. So since we didn't have negative first, interesting. 212.
0.42. 0.42.
0.42. So what is the recommendation? They should go ahead with the project because it has a positive MPV. Recommend APV rather. Recommendation. The adjusted present value is positive. Therefore, you can bring the figure and you say positive, you can bring the figure. It should be accepted. Professional colleagues. Are we good? Interesting. There is a lot of things to learn, right? Class. Is
Yes,
there
sir.
any? There's a lot. There's a lot. Can you see it now? When you think you have an understanding of adjusted present value, then when you see another question, you're like, see, the third question again will still be in another dimension, right? It will be in another dimension, but it's still, we've tested when issue cost is on equity and debt. Well, when it is being financed by equity and debt, when it is being financed entirely by debt, the next one is another, I think is on debt as well, which is that John PLC, right? So class, when a project is being financed only by equity, but only by equity, what you need to do, equity and debt. When it is being financed by equity and debt, you don't need to add the working capital as part of the cost of the investment. You only pick if it is only plant and machinery, you pick it, you share it based on the percentage given to you. Equity is this, debt is this. Do you know why it's like that? Excuse me. But when it is being financed by debt, entirely by debt, it means both the working capital and the investment and the plant and machinery used will be financed entirely by debt. That is what it means. Right. So if you don't have any equity instruments, where will you get your working capital? So it means that, well, we don't have any equity. So where will you get your working capital? Excuse me. It means that it will also be financed by what? By debt. And that is all for this question. So if you have any question on it or not, I hope I've been able to explain to the best of my knowledge, right? And I've been able to look at so many tests and SCCA. Class, do you have anyone that have question? And again, if this is your first time, if you are just joining us for the first time, or if this is your first class, please unmute your mic, introduce yourself. Please remember that we still have one question more. That question, please, can you attempt that question so that we can move ahead, please? Can you give me the assurance that you will attempt that question? Where is it? Question 1. Check the material. Question 1. I think this question 1 is 40 marks. Oh, are we done with this question first? I'm coming. I think this question has, okay, B. You can do the B part. Comment on the correction made to the original MPV estimated. That is the B part of this question. Right. So let's quickly comment on it. I'll comment on it. I think this call will end in 3 minutes. So let's quickly create another link. We need to complete this, and as well as what is it called? We'll look at that question 1 together and see if you can attempt it. Please, you just need to attempt it. You just need to attempt it. You can check more questions on adjusted present value in your first question, but guess what? It will not be as difficult as the way it is. the way all this question is, right? It will be based on, I think, that first question that we did. That is, I think that I saw one question on adjusted present value. So let me quickly create another link so that we can complete this class.
Rachel.
Class, what are the corrections you made in this form that is different from what they actually calculated before? What is the correction? Now, number one correction that you made, I'm not writing anything, I'm not typing anything. No. So if you want to write, it's better for you to do what? To pick up your pen and write, right? I'm not writing anything. Better you pick up your pen and write. And that is how I see. I want you to, you will all pass. Like I have the belief, right? But then believe in yourself that you can do it. Grace does not work in an isolation. Just make sure. Practice those questions. Do past questions. See, there is no question you want to do in that past question under adjusted present value that will be difficult than what we solve in this class. And I can like something that is very difficult. What if you see it? Now, comment. They say we should comment based on the original data, right? Now, number one adjustment that we made is that the interest, the interest was not considered because it is assumed that it has been used to calculate the cost of the adjusted cost of capital. That is number one. Interest. What again we did not consider? I need to go back to the question. I need to go back. Okay, I need to go back. Okay. What again? Okay, the working capital.
So I say it is assumed that it was what?
Mr. Moses, you see, me and you, we go fight. And
sorry, sir, I'm at work, so I'm just combining the two. Sorry.
Your attention is divided, right? Your attention is divided, have you?
Yes, sir, kind of. Sorry about that.
Okay, that's fine. So don't worry, we are in this together, right? Don't worry. My line manager will soon call me now. What is happening now? Report. We are in this together. You get. So, the interest is not considered because it assumes that we have used it to discount our project. It's part of the cost of capital that we use, right? That is one. I'm coming. Gifted. Number two is the working capital. The working capital is considered in the new base case NPV. While in the previous one, the working capital was not what? Considered. These are the adjustments that we made, right? Another adjustment is that the revenue and the direct project cost was inflated by the what? By the percentage given in the question. They said, what comments on the adjustments? You can see comment on the adjustments. See all those adjustments that you need, just write it down. And that is what they need. Right? We make adjustments on sales revenue, direct project cost. We added working capital. We exclude interest because interest forms part of the cost of capital. Right? That is the comments. Before I move to the next one, gifted. Gifted. Unmute your mic. Okay, I guess the mistake, right? Okay. The next is I think this is 8 marks. 8 marks. This is 8 marks, right? Imagine 8 marks. You can see original comment on the corrections, all the corrections we made, and I've mentioned them. Then you add your own, right? Favor.
Yes, sir. I
Favor.
wanted to say that regarding the question you said we should solve, the question one, the
I'm coming
Fatima's
back.
question, can you like give us an analysis of it so we can move on?
Although I'm kind of tired, but no problem. I will do that. Trust me, I will do that. I will do that. Is that okay?
Yes, sir. Thank you, sir.
No, good. And explain the APV approach taken in part A. What is the approach that you use? You're not right. The approach is that the ungeared cost of equity is used to what? To discount the project to reflect the business risk of the project company. That is the approach. Then the second approach is the commercial rate is used to do what? To discount the PV or financing effects. That is the approach you use. Class. Let me come again. The approach is the ungeared cost of equity is used to discount the projects to reflect systematic business risk. We already know business risk to reflect business risk. Then the second part is the commercial rate is used to discount the PV or financing effects because it starts as what the sources of finance, right? Then what are the assumptions you make? Can I tell you one? One of the assumptions is that you have only tax rates. Ideally, you are supposed to have different tax rates for the quasi company, the one you use to determine the asset beta, right? You're supposed to have different tax rates. But it is assumed that the 20% tax rate will be used for both the quasi company as well as what? The main company. That is the number one assumption. Number two assumption, which other assumption did we make from this question? Which other assumption? Let me check the question. Which other assumption? Who can give me? Who can? Oh yeah, now. Now only me they talk since I beg. One or two talk.
We assume the commercial rate for the this year, and this year for the PV of financial was 4%. That was our assumption. Using the commercial.
Yeah, it's 4%. Yeah. Is it an assumption you made? Fine. You state it. That is your assumption. You feel it is assumption. You state it. The next is the working capital. Something came to my mind. Which other assumption? My brain no boot again. No. Which other assumption do we make? So that's all. If it is just that too, it's fine. It's fine. There's nothing there. So, but I still remember before the end of the class, I will definitely let you know the assumption. Right? Gifted.
Sir, can we consider the basis point to be an assumption?
As what?
The basis point of 100 basis points be an assumption.
No, don't consider it. Don't consider it. Don't consider it. Okay, another assumption. Okay, go ahead.
What about the beta equity and beta assets?
That is what I want to talk about. Thank you. That's a very good one. I want to say that it is assumed that the asset beta will represent the equity beta. Don't forget, when we calculate the asset beta, we use it to determine the cost of what? The cost of equity using the CAPM. Then the place of equity beta, we assume that okay, now state it. It is an assumption that the asset beta is still the same thing as what? Equity beta. That's a very good one. Thank you. Which other assumption? See, just look at the calculation. Any assumption you made, just write it down. So that is 8 marks. Gifted. Okay, I think it's a mistake, right? Okay, question 1, right? The first question, question 1. Question 1. What happened to my system? Question 1. Question 1. Oh, my system is not. I don't know what happened. Please, can someone just check? Hello, please confirm if you can hear me. Can you hear me?
Yes, I can.
Yeah, I think my system is hanging.
Yes, I can hear you.
Okay, so can someone start? Please read the question 1, please. I think my system is hanging, so while I'm trying to fix it. Okay, I think I'll be able to do that. So, this. Rachel.
Okay, sir. John Tayo JT is an unlisted Nigerian company producing paint. Although JT currently has significant surplus, the result of the success of its paint products over the last few years. The company's managers believe that its future growth potential in the paint industry is limited and are considering diversifying into the production of tiles. A project team has been constituted.
Okay, hold on. Sorry. So you can see they are not considering diversification as an option, right? They are not considering what? Diversification as what? As option. And something should just come to your mind that, oh, there will be a quasi company. Something should just come to your mind. There will be a quasi company. Okay, please go ahead. I'm trying to admit people in. I don't know what is happening. My system is not. Okay, please go ahead. I can hear you.
This team has been constituted and a member of the team has produced. Can you hear me, sir?
Yes, go ahead. Go ahead.
Okay, sir. A project team has been constituted and a member of the team has produced the following draft financial proposal. Side
Okay.
project, as you can see.
Yeah. So this is the project proposal, right? This is a project proposal. Can you see it? Okay. Go ahead.
Additional information. 1. All data includes the estimated effects of inflation on cost and prices wherever relevant. Inflation is forecast to be 2% per year for the foreseeable future.
No, hold on. Hold on. Now, you can see now, all data include the estimated effect of inflation on cost and price wherever relevant. Inflation is 2%. Now, they are giving us inflation per year in any cost or the price, but they did not mention that, oh, it's on this amount, it's on this, it's on this. They say wherever what? Relevant. Right? Continue. B.
The investment in plant and working capital will be financed by 6 years, 8% fixed rate term loans. The interest cost has not been accounted for in the above analysis.
Hold on. Now, can you see the the plant and machinery of 750? The working capital of 50? The investment in plant and working capital will be financed by a 6-year, 8% fixed rate term loan. Something should come to your mind that this project may be financed entirely by debt because 8%. Can you see it? No, I don't think they even mentioned that. Okay, I don't know. Let's continue first. Can you are you getting the gist? No, you see the investment in plant and working capital. Plant and machinery is 750. Working capital is 50. Right? Which other cost that is there that make up this? Sorry. Okay. Right? I'm coming. Sorry, I'm just trying to. Okay. Right? And this to tell you that this project may be like 99% financed entirely by debt. Because if your plant and machinery and your working capital will be financed by 8%, 6 years, 8%, please take note of that. The interest cost has not been accounted for in the above analysis, okay? Okay, go ahead. Go ahead. Go ahead.
Believed to have 1 billion to the
Okay.
company debt capacity.
Okay, sorry. The investment, you can correct that, is believed, right? Believed to add 1 billion to the company debt capacity. Class, this question is another question that is interesting. They have plant and machinery as working capital. Plant and machinery, working capital is part of the cost, initial cost, right? And we were now told that the investment is believed to add 1 billion to the company's debt capacity. Now, what is the total cost of the investment? Plant and machinery is 750. Is 750. Working capital is 50. The total is 800 million as the cost of the investment, and they now believe that they will add 1 billion capacity to their debt. Already debt is 800 million, and they want to add 1 billion. So what they want to add one. So definitely you have 200 million to complete what? 1 billion. So their debt capacity for this investment will be 1 billion. They have 750 million as plant and machinery. They have working capital, and they believe that they will finance in quickly go back. The investment, which is this particular investment, is believed to add 1 billion to the company's debt capacity. The company's debt capacity is 800. So what will make it the 1 billion? To make it 1 billion is 200 million. Then when you add it, you have 1 billion. And that is the company debt what? Capacity. The question is now, how do we go about it? What are we going to use the 800 million for the project? What will happen to the remaining 200 million? All right. Class, do we get that? Hello? Oh, I think we are tired, right? Okay, we need to, I think we need to go.
Let's continue, sir.
Ah, okay. Go ahead. Go ahead.
Idle production staff would need to be taken from other activities, resulting in a loss of 4 million per year, tax contribution for 2 years.
Hold on. Don't forget. Hold on. Don't forget that there is a proposal that has been in existence, right? There is a proposal there is a financial proposal that has been in existence. You have to redraft this proposal because some of these cash flow, some of them are not relevant, but they use it, right? Some of them are not what? Relevant, but they make use of it, right? Now, the high skills production, okay, the high skill production staff would not be taken, would need to be taken from other activity, resulting in a loss of 4 million per year for 2 years, which means that you need to add, there's a contribution loss, which is relevant under the concept of relevant costing. Is an opportunity cost. I'm working in a project A. Project B need my assistance. I will move from project A to project B. Project A will lose a contribution as a result of that. Of course, when I get to project B, they will pay me my labor cost. What is the total cost? Is the contribution loss plus the amount they paid you. So now, in this question now, there is a loss on contribution as a result of moving high-skilled labor to this particular project. And the contribution loss will be pre-tax contribution for 2 years, which means for year 1 and year 2. Go ahead.
The introduction of the new product is enhance the sales of some of the existing products, such that annual contribution post-tax increase by 20 million for 4 years.
Thank you. The introduction of the new product is expected to enhance the sales of some of the existing plant products, such that annual contribution, there will be an annual contribution post-tax, that is after tax, you're taking after tax into consideration, we increase by what? 20%, 20 million for what? For 4 years. 20 million, 20 million, 20 million. So there will be, as a result of this project, as a result of introduction of new project, there will be a contribution after tax. So when you are redrafting that proposal, you have to add, when you are redrafting that proposal, you have to add a contribution. That contribution will be post-tax after tax. Post-tax, that is after tax. So 20 million, year 1, 20 million, year 2, 20 million, year 3, 20 million, year 4, 20 million. Class, am I communicating? Go ahead.
A federal government agency is expected to give a 2% per year subsidy to the cost of the loan to support the creation of jobs associated with the project.
Fantastic. At the beginning, we were told that 8%, both plant and machinery and working capital, will be financed by 8% fixed rate. And government is now, you can see the technicality. Now, government is now saying, we'll give you, no, we'll subsidize it. 2%, which means that it will be 2% below the 8%. So, the subsidized will be 2%, 2 minus 2 from 8 is what? 6%. So, the subsidized will be 6%. The commercial will be 8%. Class, are we together?
Yes, sir.
Do we get that? You can see how it is. Then you will now ask your question. Oh, you ask yourself, 2%. So the subsidized is 2%. So That is very wrong. If it will be financed by a fixed interest rate of 8%, that is the commercial rate. That is the commercial rate. Then government want to subsidize it for 2%. 2% subsidized. They want to reduce it. 2%. You can see they did not tell you that it is below the commercial rate. 2% below the commercial rate. But you should know that if this is 8%, they want to subsidize. Okay, 2 minus 8, 6%. 6% should be subsidized. Why 8% should be what? Commercial. Go ahead.
Incremental head office cash overhead will be 2 million per year.
So there will be an incremental head office. So this particular cost is actually a relevant cost. So per year, for the numbers of years, you will have 2 million per year. Okay.
Corporate income tax rates is at 25% per year, payable in the year that the tax liability arises. The company has profitable projects.
Good. So which means that tax is being paid. The year at which we realize we make the profits, you pay the tax. No arrears. Right.
Liable depreciation on plant and machinery is 20% for the first year, and straight line thereafter. The plant and machinery have led working life of 6 years. Major new investments will be required.
Now, this question is kind of technical, but guess what? It's simple. What we were given is from the proposal. What you will just do from this proposal, remove what is relevant. What is relevant, we'll look at it. What is not relevant, we'll remove it. What is relevant in the additional information that they state, this loss on contribution, this incremental, you add it. It's part of what you will quote. Now, this project, this is for 4 years. So this is 4 years. And we were told at the beginning that the cost and the price will increase if we're relevant 2% per year for the foreseeable future. And in the same question, we were now told that the plant and machinery is what? Is for 6 years. So how do we now get the prices and the cost for year 5, year 6? Now refer back to the first for the first Roman figure 1. They said the cost and the price will increase by 2% when necessary, wherever relevant in the future. So, which means that when you want to do either the base case or financing effect, it will be from year 0 to year 6, because the plant and machinery will last for 6 years. So therefore, when you pick material is relevant, you know the material year stop at year 4. You increase it by 2% stated at Roman figure 1 of this question, because it was stated that it will increase. The cost and price will increase by 2% wherever relevant. And wherever relevant, when it is relevant. And the project given to you 4. But they say the plant and machinery is for how many years? 6 years. You need to add 5 and 6. So all your relevant costs, you increase it by 2%. The relevant cost stated, you increase it by what? 2%, or unless stated otherwise, 2%. To make it year 1, year 5, you increase it from year 4. After year 4, you have year 5, you have year 6. Class, is that clear?
Sir, please, will there be any effect on all other relevant costs as regards year 5?
Yes, we'll get there. We'll get there. Because they say cost and prices. So we will know the one that we have to inflate after that. Don't forget your revenue, all your relevant costs And don't forget, there are some costs stated in this question that they said it is an incremental. It is per year. It is per year. It is what? Incremental per year. We'll get there. Don't worry, we'll get there. Okay, the next one is tax allowable depreciation on plant and machinery is 20%. Okay, we know this. 20% for the first year and straight line method thereafter. So you charge 20% in the first year and straight line method. Wow. Okay, the company has a current weighted average cost of capital of 12%. So the weighted average cost of capital is 4%, 12%. The company equity beta assumed to be 1.0. That is, excuse me, that is JP. Their WACC is 12%. Their equity beta is 1.0. Now, the average equity beta of company in the ties sector, don't forget they want to diversify into ties. So they've given you the average equity beta that you will use to determine your cost of equity of the ungeared company. Right? So the market return is given. The risk-free is given as 5%. What else? So the JT, you can see, don't forget that book value is not relevant. It's not always relevant. What is always relevant is the market value. So they're giving the market value of, if at all we want to need it, if at all we will need it, sure. I don't think we don't need it now. JT market value is given. Then, what of the industry? What of the ties into industry that they are diversifying into? You can see the market value is also given. So 60%, the market value is 60% for equity, 40% for debt. Then the market survey was completed last month and payment is due in 6 months' time. Don't forget, market survey has been included in these financials. Does market survey, is it a relevant cost? Market survey is not a relevant cost. So when you are preparing it for 6 years, when you are preparing your 6 years, okay, what is relevant? Material is relevant, of course, you will use it. Wages is relevant, of course, you pay your casual labors, as well as you also pay salaries as well, right? Then your allocated head office, we don't know yet, that we need to check. Anything that has to do with apportionment, allocation, it is not allowed. Allocation, apportionment is not allowed, right? But let's check. Let me quickly complete this before I come back to that. Now, the market survey given to you, you remove it sharp. It's not relevant. Because it's not relevant now. Market survey, whether you like it or not, before the project, you do survey. So it's not relevant. So after tax net operating cash flow, after year 4, are expected to stay approximately constant in real term. After tax operating net cash flows. After tax operating net cash flows are expected to be in real term. The other specific overhead will remain at, should be in nominal term. This should be, will remain at 10 million. Sorry, this is 10 million. This is 10 million. 10 million in money term. You can see other specific overhead will remain at 10 million in money term. So, which means that the specific overhead given to you will remain more is in, where is it? This is it. Will remain 10. So, which means that when you want to do from year 4, this is year 4, right? You will do year 5 and year 6. You leave it at 10 because it's already in what? In money 10. You don't need to inflate it by 2% again. You don't need to do what? Inflate it by 2%. But any other cost that is relevant, you have to do that. Like this one now is relevant. You have to inflate it by 2% given to you. The wages and salary, the salaries as well, you have to inflate it as well. So we don't know whether they give us any notes. So market survey, you remove market survey is not relevant. After year 10, they say it remain 10, right? It remain 10, which is a market survey, right? And we don't know if so it's remaining allocated head office and marketing. Let's check. We need to check if they give us any notes to that. Of course, marketing is a relevant cost. Do you know why? Because it is for the project. We want to market the capital investment. You will do marketing now. All those people that they will give you paper, they will give you flyer, all those things. So marketing is actually what is a relevant cost here. Why? Because marketing is a relevant cost, but you have to inflate it. You inflate it by where is the marketing? You inflate it. So there's no year 4, right? There's no year 4. And marketing. Okay? Marketing. Marketing. Okay. You can see that marketing is 10. It's constant, right? And other specific is also constant. They say because they say it is measured as real term already. So this marketing will remain the same. So we can use 10 all through. Marketing will remain 10, then the other specific overhead will remain 10. Don't forget, it was mentioned that specific overhead will remain in money term. Why the marketing? Of course, you don't expect your marketing cost to increase. If your marketing cost is increasing, as the project is going, there will be a problem, right? Psychologically, you don't expect it. You already it's already programming that this is how much you spend for your marketing. You should not increase according to the numbers of years. Marketing expenses is at the beginning. Bam. We said, oh, we want to spend 50,000 or 50 million. So it is not expected to increase. Look at it. Even in year 2, year 1 is 21. Year 2, it decreases 10. In year 3, you have 10. So year 4, it is nil. So you can have because you need year 5 and your year 6. So you can assume to be 10-10, right? You can assume it to be what? 10-10, because marketing expenses will not increase. Will not what? Will not increase, right? So which other one again we need to touch? Which other one we need to touch? Okay. Lastly, issue cost on debt. Don't forget, this project will be financed entirely by debt as well, because they've mentioned at the beginning that the plant and machinery and working capital will also be financed. Right? Plant and machinery and working capital will be financed by 8%, right? Will be financed by 8%. So this shows that the project is financing entirely by debt, right? So issue costs on debt are 15% of the net amount needed to finance plants and to finance plants and expenditure, plant and expenditure and working capital. So what is the total amount that you will use to finance both plant and working capital? Don't forget, the plant is 750 million, the working capital is 50 million, that is 800 million. Now, the company believed that the investment is believed that I think there is a statement there, the investment is believed to have 1 billion debt capacity. Finance 1 billion. So now, if you have 800 million, you need to raise the total debt capacity is 1 billion. So you have 200 million. Is that not so? So you have 800, then you have what? 200 million. So in this case now, we need to check what is it called? The issue cost. Don't forget, you have subsidized loan and you also have what? Commercial loan. Don't forget, the subsidized loan is 2%. That is 6% for subsidized rate. The commercial is 8%. Is that not so? Then you do the issue cost on both subsidized as well as what? Commercial, commercial. So, lastly, acting as an external consultant, you've been asked to prepare a report on the proposed diversification of the company into the production of ties. The report must include the revised financial analysis. You should use the adjusted present value method for this purpose. Include in your report discussion of the limitation of the method used and other financial and non-financial factors include real option that JT might consider prior to making the investment decision. Present your report, and that is 34 marks. So discuss whether this will diversify their risk, and this is first. So first, calculate first. When you calculate, we see what we can do about that, right? So, class, I'm done with the analysis. Favor. Pemisiri, are you still here on this call?
Yes, I am.
Okay, that's fine. Okay, so
So I
please,
have a clarification.
right.
So the first thing we're going to do is first draft the revised financial analysis.
Yeah, that
Then
is
we
the
do
base
the
case MPV. Yeah.
then we do the adjusted present value.
Yes. Is the whole thing is to calculate adjusted present value. Check the required now.
Okay. Regarding additional information 6, tax allowable depreciation
Okay.
is not part of our financial analysis, Abi.
It will be now. It's allowable. It's allowable. That is where we have tax savings. Is that not so? Is that not so? That is when you have tax savings. Hmm?
Like I need the forecast, the draft.
Okay. 20% for the first year. What is the cost of the plant and machinery? 750. What is the 20% of it? And they say and straight line thereafter. After that, it is not a reducing balance method, but it is just that same amount. And straight what? And straight line. So what you need to do is that 20% of 750 is like your capital allowance for the first year, right? For the first year. So for the second year, what will you do? And straight line thereafter. Straight line and thereafter. Um, and straight line thereafter. So what will you do for the straight line? For the straight line. It's still the usual. Favor. It's still
Yes,
the
sir.
usual. Try it. Let's see what you have. Try it. Just try it. Let's see what you have. Because just try it. Let's see what you have. Is there any other one?
No, sir.
Uh, so I think I've tried. Do it anyhow. Do it. Attempt it. Let's see what you have. Then once you do it, then we'll see how we can make adjustments from there. We'll do adjustments. We'll do it. We'll do the adjustments because we can't even solve this question again. But let's see how it goes. But attempt it is very important. Any other question before we go?